The Indian markets open lower as range-bound trade continues. The Nifty slips below the 25,500 level as most sectors except metals and realty trade with losses. The broader market trades in line with the key indices.
Power financiers REC and PFC, they rally as Morgan Stanley initiates overweight calls on both the stocks, expecting 12% loan growth CAGR over the next 3 years.
Home First Finance surges as Bernstein initiates an outperform rating on the stock. The brokerage sets a target of 1,650 rupees a share, expecting the company to see faster growth and superior productivity with prices.
ITA rallies as the government allows it to raise funds via capital gains bonds, which allows for lower interest rate and tax benefits for investors.
TCS will kick off the first quarter earnings season with its results later today. A CNBC-TV18 poll sees a constant currency revenue falling in the first quarter of FY26, while margin is expected to be maintained at around 24.3%.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Vinny in bright yellow today. Vinny, market's a little bit red.
I'm the only one who's shining in the market since the last week. There's nothing happening there. So I was like, let me bring the shine and come here today.
Modesty, yeah?
No,
So we normally have green, red, and now we have yellow as well. But the markets, seem to be in a bit of a flux, in the near term. The Nifty is waiting for cues. Remember, the big cue that's going to be coming on the domestic front is going to be earnings season that gets underway today with big boy TCS that will be reporting their numbers. And, in terms of the mid-cap action, though, you still have more number of stocks that are advancing than the number of stocks that are declining. So that's heartening as well. We had some flashes with regard to Pharma that comes up for you on the screen. That should come up in just a bit. We'll get Ekta to detail that as well. There are some observations with regard to Halol. And split verdict, actually. Some saying that it's not as bad as anticipated. But the stock is actually at the low point of the day. We should keep an eye out on Sun Pharma. I think at some point of time, Director will be pulling that one up for you on the screen. Let's go to Sachidanand Rutekar, though, from Trade Bulls for a technical check on the markets. Hi, Sachi. Good morning. Good to see you win. Markets lagging triggers, right? Waiting by for Trump earnings and wondering what's going to happen next. What's your take? This 25,400 odd level has been holding out. Would you look to buy or would you wait buy?
Good morning, Nigel. Nigel, clearly the range is well defined. Unless we don't see a breakout above 25,550, we may not see the resumption of direction momentum. On a broader basis, we still continue to be on the bullish side. This is mere consolidation that we are observing. On the lower side, at least for the day, 25,350 is a kind of support wherein some buying can be initiated. Else, I think one should wait for a breakout decisively for this particular level to be taken off at around 25,500, 550. And, some aggressive long positions can be considered once this breakout is in place. When it comes to Nifty Bank, I think there could be some outperformance here. We are liking Nifty Bank and Nifty Auto. The structures are very good. There is a possibility of good relative outperformance within this particular space. So we are of the bias that eventually we may see the Nifty, breaking this particular hurdle at 25,550. And hence, even on a decline, the recommendation is to add long positions, keeping a stop loss somewhere close to around 25,320 on a closing basis. One can, accumulate Nifty near to that 25,400 mark. And on the higher side, review positions once, it is closing towards that breakout zone of 25,500, 550.
Okay. Sachidanand, anything in terms of specifically you're seeing coming in for campus activewear, that's buzzing in trade and, good volumes is what we're seeing as well today. So anything specifically on that front as well as what are your top bets?
Well, campus, the overall structure has been fairly negative. There have been bouts of buying, which we have seen in the past. But if you look at the broader structure, the structure is still weak. We are of the opinion that there could be some more steam in this particular rally, but eventually 310, 330 looks like very significant hurdles. So from a trading perspective, one can initiate some long positions, but the stoppers has to be very specific to that 270 mark where it's 200-day exponential moving average is placed. So I would not recommend adding long positions here, but in case if someone is holding, one can put a stop loss at 270 and review positions close to 310. When you look at stocks, I think Nifty Auto and Nifty Bank, I think they are very significant right now. SBI from that space is still consolidating well. We are expecting that the movement within this 810 to 830 zone, I think it is still valid, and one should stay long with the stop loss at 810 on a closing basis. We are expecting a rebound back to around 825 levels, so a buy on SBI. And the second stock is Maruti. Now, if you look at the last 3 trading sessions, despite of the market weakness, this particular stock has been forming a base near its 50-day exponential moving average support, which is placed somewhere close to around 12,460. So keeping a stop loss at 12,460 itself on closing basis, one can expect a rebound back in this particular counter. And hence, we are recommending building long position for a positional target of around 13,160.
Okay, Sachidanand, thank you so much for joining in with us, giving us a check in terms of what to expect from the market as well as your top bets. But let's shift focus to our special segment where we will get you a few ideas from for profit from Money Control Pro. Sachin Pal of moneycontrol.com is joining in with us to talk to us about the stock that he's tracking closely. Sachin?
Electronics manufacturing company Syrma SGS ended the year FY25 on a promising note with its highest ever quarterly as well as annual net profits. While the revenues in Q4 FY25 were lower by almost 18% year-on-year, the company witnessed strong expansion in operating margins and witnessed a growth in terms of operating profits by almost 46% year-on-year. Among the different business verticals that the company operates in, it witnessed strong traction across auto, industrials, IT as well as railways. However, there was some weakness exhibited in the healthcare vertical and as well as in the consumer verticals. The weakness in the consumer vertical is primarily attributed to the fact that the company is looking to move its focus away from the low margin consumer business. Well, for FY26, the company is aspiring a top line growth of almost 30 to 35% on a YOY basis with EBITDA margins of almost 8%. And this is backed by a healthy order book of almost 5,300 crores, which is split across different business verticals. Besides, the company is also looking to apply for the component PLI scheme with a technology partner. The company continues to remain on a very strong footing, and the stock has also seen a very sharp run-up in the last few months, and currently trades at close to its all-time highs, which is and in terms of valuation, it's trading at around 40 times FY27 estimated earnings. Given the steep valuation, investors should therefore look forward to accumulating the stock during a weak phase of the market.
Thanks so much for that, Sachin. Surely EMS players are something that are in focus because yesterday only we had a brokerage note also that came in from JP Morgan initiating coverage on this one. Today, Gautam Trivedi also spoke about these EMS players. But on that note, we're going to slip into a very short break. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. Well, let's focus on a couple of stocks and sectors. Home first. That one is buzzing post a bullish note that came in from Bernstein. Gaurav joins in to help us out with the detailed analysis on that report. Gaurav, take it away.
Well, yes, housing finance companies, specifically Home First, is in focus today, and the reason being that Bernstein has now initiated a report with buy rating on many of the companies and also market perform on a few. So first, let's talk about companies like Home First Finance, Aptus and Aadhar, where Bernstein has maintained or rather initiated with their outperform rating. On Home First Finance, what they're saying is that it is actually the most preferred pick from the pack, and the reason being that the company actually stands out in demonstrating the ability to consistently replicate its portfolio and its business model across multiple states. Other than that, what they're saying is that there are some key points like faster growth, smaller size, which is helping the company even further. In terms of Aptus, why they are bullish is that specifically in terms of this company, the fixed rate loans are high, and this is actually helping the company in an environment where we are seeing the rate cuts. Aadhar Housing Finance is also one company where they are being a little bullish, and the reason being that they say that this company has the largest and most geographically diversified portfolio, which is helping the company company to even grow further. On the other hand, they have initiated with market perform rating on Aavas Financiers. What they're saying is that this company is actually lagging its peers when it comes to yield and profitability, and that is the reason for now they have initiated with market perform. And lastly, for PNB Housing, again, they have maintained their market perform rating, because what they're saying is that the shift towards smaller ticket size is actually positive. But on the other hand, the aggressive strategy that the company is implying right now is raising a few concerns, and that is the reason for now they are being a little cautious with market perform rating. But definitely on the back of this news and the note, we are seeing some reaction in the stocks. As of now, we are seeing some uptick in Home First Finance as we speak.
Okay, Gaurav, thank you so much for that. But the Finance Minister Nirmala Sitharaman also called on NBFCs to significantly scale up their role in financial system. Let's listen into what she had to say.
You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled. 24 became 48. You can do it even now. So, as India moves forward, NBFCs will have a key role, no doubt, in meeting the credit needs of the future, including in areas like green initiatives, affordable housing, and MSMEs. To reach, and the reach that you have is the biggest strength that you have. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors. NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. The stronger regulations and oversight is the best testimony. The stronger regulation and oversight is the best testimony of your importance in the financial system and the broader economy.
All right, let's move on to Bharat Dynamics. That's trading lower following a note coming in from Motilal Oswal. Ria joins us to fill us in with details on that note. Ria?
Well, yes, Motilal Oswal has initiated coverage on Bharat Dynamics with a neutral rating and a target price of Rs 1900, implying a 4% downside from yesterday's closing price. Now, the brokerage has noted that BDL's revenue has been impacted in recent years, largely due to supply chain disruptions and challenges in sourcing critical components, particularly from Russia and Israel. However, these headlines are beginning to ease out, and they are expecting a sharp recovery in revenues going ahead. They are projecting a 35% revenue CAGR over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully. EBITDA and net profit are expected to grow at a CAGR of 64% and 51% over the same period. Now, the report has also highlighted strong order visibility for the company. They have an existing order book of about Rs 22,700 crores and a potential pipeline of about Rs 50,000 crores, including large deals like QRSAM and the upcoming emergency procurement orders as well. On the macro front, the company is also well positioned to benefit from favorable defense sector tailwinds, be it the rising global defense spends, the growing exports of the Akash missile systems, or the ongoing collaborations with DRDO. That said, valuations do remain a sticking point for the company. Currently, it's trading at 70 times the FY26 estimated earnings, and hence they do suggest waiting for some better entry levels for the stock. On the back of this, the stock has been under some selling pressure, trading about 2.5% lower today.
Okay, Ria, thank you so much for that. But let's move on and talk about TCS, because that's expected to kick off its Q1 numbers today. Rima is joining in with us to give us what are we expecting this time. What is the CNBC-TV18 poll indicating? Rima.
Thanks so much for that. So expect a muted quarter from TCS. The most important number is their revenue growth. Constant currency revenue growth is likely to decline by nearly 1.5%. In dollar terms, you will see a growth, and that's on account of the cross-currency movements. Basically, the dollar depreciated a lot against other currencies like the euro, the yen, the pound, etc. But the key number will be the constant currency revenue growth, and that is expected to drop sequentially by nearly 1.5%. So that's a big, disappointment. Secondly, margins. Margins are likely to remain flattish on a quarter-on-quarter basis. Oh, sorry, I forgot to mention, the reason for the revenue drop is because of the BSNL contract, which continues to ramp down. That's the reason why revenues will come under pressure. Now on the margins. Margins are seen likely flat on a sequential basis. Remember, this time there is no wage hike. The wage hike, which typically happens 1st of April, was deferred by the management, citing uncertainty. So the question that analysts have is that then why are margins not going up? Anyway, there is no wage hike, and plus there is lower contribution from the low margin BSNL deal. So, it's reported that BSNL margins are in in single digits. So therefore margins, actually should have gone up when there is a ramp down of the BSNL contract. That's not taking place. So what will you watch? One is a pickup in growth, because the international growth, ex of BSNL, has been a bit subdued, lackluster. The growth was primarily driven by the BSNL deal. So despite strong deal wins, the international growth has been fairly muted. Secondly, we spoke about margins. How will the margins expand from here on? Thirdly, timing of the wage hike. You didn't give it in 1st of April, but now do you think there is scope to give wage hikes for this year? And lastly, the deal wins. Deal wins last quarter were very strong. They came in at close to about $12 billion plus. So how about the deal wins, given all the uncertainty that we've seen in the quarter gone by? Back to you.
Okay, all right, Rima, thanks a lot for that. But let's slip into a short break. As we do that, let's bring you some good news for all our viewers. India's business news leaders now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app now from the Apple Store, the Google Play Store, or simply scan this QR code that's up for you on the screen. Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, research firm Viceroy had come out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying horse. While Vedanta has hit back, stating the sole objective of Viceroy research report is creating a false propaganda. So let's get a little bit into details. First, is Vedanta's debt still a problem? And if you just look at what they've done, Vedanta Resources first, their debt has nearly halved in the last few years. From around $9 billion, it's down to sub $5 billion. And they've also said that they'll be reducing their net debt by close to $3 billion in the coming year. Out of that, $1 billion done. So $2 more billion is what they're looking at, which effectively means the debt will fall down to sub $3 billion, approximately. So Vedanta Resources actually has done a fair bit of deleveraging. Even if you look at their maturity, it appears they're fairly well placed. And because they have some obligations, Vedanta Limited shareholders could be looking out for a bit of a sweetener in terms of, dividend paid. So we'll have to keep an eye on that front, because that's Vedanta Resources' debt repayment, debt maturity cycle. Remember, they've refinanced some of this debt at a lower coupon rate, which will save them on interest costs in the times to come. That's about Vedanta Resources, which is the parent, which has been the problem that how jittery is Vedanta Resources. They're in far better shape, I can tell you, in comparison to a couple of years ago. Moving to Vedanta Limited, they have been undertaking a big capex plan, right? But the net debt number actually has come down. We should pull up what is the recent net debt number. I think my director will get that up for you in just a bit. It's around 53,000 crores. But on a year-on-year basis, as well as on a sequential basis, it compares with around 57,000 crores. However, for metal companies, you normally want to look at it on a net debt upon EBITDA basis. And that number was close to around 2 or even more than that. But in the last few years, it's come down from around 1.5 times, 1.55 times, it's come down to around 1.2. And the management has stated they're looking to bring this number sub that one time odd. So on that front as well, they've done a fair bit of work. So both Vedanta Resources as well as Vedanta Limited actually are in far better shape in comparison to a couple of years ago when things were a little bit jittery. In fact, I questioned Mr. Gabriel, the co-founder of Viceroy Research, and I also spoke to Rakesh Arora of Go India Stocks. While Viceroy believes that Vedanta could be at the risk of default, Rakesh Arora says this report from Viceroy could be a couple of years too late. Let's hear them out.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an event of default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt. That's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research, and we think that the end result is a disorderly collapse. We think that Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets. which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Okay, and with that, we're absolutely out of time on this edition of Chartbusters on CNBC TV18. Thank you so much for tuning in. The markets have seen a bit of a slip in the last few minutes. Keep an eye on that. 25,388 around that level is what the Nifty is at right now.